Good evening. On behalf of the Student Academy of Doctors of Audiology, I would like to welcome you to today's Student Practice Management webinar on analyzing your practice relative to the competition and strategic development. My name is Brian Doty, and I am pleased to serve as today's course coordinator. I have just a few housekeeping reminders before we begin. If you have any technical challenges during the session, please use the chat feature to make me aware, and I'll be glad to assist you. Please type your questions into the question queue, and they will be addressed by presenters at the end of the presentation. Today's presentation is being recorded and will be available for online viewing next week. At this time, it is my pleasure to introduce the course moderator for this session, Kate Witham, the current S.W.O.T chair and fourth-year student at Gallaudet University.
Thank you, Brian. On behalf of the S.W.O.T board, I am excited for the opportunity to welcome AUD students from programs across the country.
Hey everyone, this is Craig Castelli. I'm your speaker, and we're going to talk about practice analysis and strategic analysis and ways to evaluate various practices, big and small, from different perspectives. Kate, if you're back, I can hand it back over to you if you'd like.
Back. Sorry about that. So it is my distinct pleasure to introduce Craig Castelli. Craig Castelli is the founder and CEO of Caber Hill Advisors, a middle market investment banking firm headquartered in Chicago. Caber Hill is committed to working with business owners and CEOs so they can successfully fulfill their personal and professional legacies. Craig founded Caber Hill in 2014 and quickly built the national leader in advising audiology practices on M&A, valuation, and capital markets. The Caber Hill team brings extensive audiology practice acquisition experience. Have previously worked on the retail acquisition teams at Beltone, Oticon, Siemens, Sonova, and Widex. The firm completes numerous audiology transactions each year involving doctor-to-doctor sales, as well as sales to hearing aid manufacturers, private equity investors, and privately owned consolidators. Greg is a frequent speaker at audiology industry conferences and volunteers his time to teach AUD students at Rush University in Chicago on finance, accounting, and business strategy. So at this time, I would like to turn it over to Craig.
Thank you, Kate. Welcome, everybody. It's a pleasure to be here again. I always enjoy speaking to groups involved with ADA, and I think tonight should be no difference. I'll jump right ahead because you know what we're going to talk about. The agenda for this evening is to go through various frameworks for analyzing practices. We'll start with some financial analysis. I promise to keep it as brief as I can and not get too into the weeds in numbers. I will then move to practice analysis, which in this case really refers more to clinic level KPIs as well as how practices are analyzed by potential buyers and investors. And from there, we'll move into some more general strategic frameworks. These are often taught in MBA programs, are applicable to just about any type of business out there, and can be very useful when you can bring these frameworks to the audiology industry. And then we'd be remiss if we didn't talk a little bit about COVID and everything going on in the world today and how that impacts practice analysis. If I do my job correctly, we'll get through all of this in about 45 minutes and have plenty of time at the end for questions. So we'll jump right into the financial analysis. One thing I'll note as well is that most of this content is pulled from the classes I teach at Rush. So if we have any Rush students on tonight or watching the recast who haven't had my class yet, you'll have a leg up on your fellow students from what you'll learn here over the course of the next hour. So financial analysis really revolves around financial statements and how we can take a look at financial statements, manipulate the numbers in financial statements to get a better understanding of practice performance. And there are three core financial statements that any business can produce: an income statement, a balance sheet, and a statement of cash flows. Tonight, we're only going to focus on the income statement. That's about all the time we're going to have to cover right now. And I think this, if you're going to learn one, contains some of the simplest concepts to grasp for anybody who doesn't have an accounting or finance background or even any coursework in their past, and will be the most relevant to what you may do in your career going forward, regardless of the clinic setting that you're working in. So the income statement is also known as the profit and loss statement, and as the name suggests, it tells you how much income a business generates, or how much profit the business makes, or how much money it loses over the course of a period of time. And we'll take a look at income statements usually over 1 month, 3 month, or 12-month periods, and they tell us performance for the duration of that period. We can also look at comparative income statements. So looking at an income statement over 2 to 3 consecutive years can give us a really good indicator of how a practice has performed over that period of time. Does it grow? Does it decline? Has it improved profitability by controlling costs? Things like that. If we take a look at the top right of the screen, we see this section that shows net revenue, cost of goods sold, and gross profit. This is the first part of the income statement that I'd like to highlight. So net revenue simply is how much money the practice took in through the course of whatever period of time we're looking at. In this case, we have a 1-year income statement taken from a client of ours with some numbers rounded off or changed just to protect any identities. So net revenue is kind of the gross dollars collected by the practice from patients, insurance companies, any other customers, netted against any returns. So we subtract anything that was refunded, and kind of that amount that's left before any expenses whatsoever are taken out is our net revenue. So in this case, that figure's $2.5 million. Right below that, we see cost of goods sold, and simply put, this is the cost to the practice of anything that it then sold to a patient or customer. So when it comes to audiology, this primarily relates to hearing aids, but could also contemplate batteries, other types of equipment, whether it be a PSAP or some type of accessory to a hearing aid. And then the simple equation of revenue minus cost of goods sold gives us gross profit. And if you look to the right here, which is actually covered up for me by the controls, but here we go. We can see the percentages. I dropped in percentages across all of these expenses. We see cost of goods sold is 34% of net revenue, so it's a percentage of net revenue. And then the inverse of that, gross profit, is 66% of net revenue. We use a traffic light system to identify, good, okay, or bad performance. So these highlighted in green means these percentages are strong. And so when we look at P&L, profit and loss statement, one thing we want to understand is these percentages or these financial ratios, because they tell us how strong the practice performs in certain areas. For a small to medium-sized practice, single location, couple location, we use the benchmark of 35% for cost of goods sold. So if your cost of goods sold are 35% or less, meaning your gross profit is 65% or greater, you're doing pretty good. There are certainly practices that perform better, and as practices get larger and have more leverage over hearing aid manufacturers, you might see this drop to 30%, 25%, even 20% in very extreme cases. On the other hand, if you see cost of goods sold coming in above 35%, especially if it's above 40%, that's an indicator that financially the practice is not performing as well as it should. And either that means they can or should be able to negotiate better pricing with hearing aid manufacturers, or there's an opportunity to raise prices because they're not charging enough for the hearing aids. Either one of those levers could drive the gross profit and the cost of goods percentage. And so, when you evaluate a practice, you take a look at cost of goods sold as a percentage of revenue. The next step is to evaluate pricing and understand why cost of goods sold may or may not be strong. Kind of going down from there, we see compensation broken out, and then we see all of the other operating expenses. I've called out compensation here, but you'll notice I haven't highlighted any of the percentages. And I just want to share my reluctance to give a benchmark percentage for compensation as a percent of revenue. One, there's no really universal consensus within the industry, although a lot of people will say 25 to 30% of revenue is in pretty good shape. Two, when you're looking at a profit and loss statement, there are a few things that you need to understand about the practice in order to understand compensation. The first being whether or not the owner's compensation is included in payroll. And if it is the owner paying themselves at fair market value? Sometimes you'll find owners take dramatically high or dramatically low salaries. And they do so for various reasons, usually related to taxes, but understanding whether the owner's salary in here reflects what they could be replaced at by an employee or some different number drives your analysis of compensation. Two, there are significant market factors that drive this. It costs a lot more to employ an audiologist in New York City or San Francisco than it does Toledo, Ohio. And so, until some of these dynamics, it's hard to just look at compensation in a vacuum and say it's high or it's low. Moving into the operating expenses, I've highlighted two items here, advertising and rent. So advertising for this practice is $250,000 or 10% of revenue. And I've flagged this as yellow for a reason. The most common answer you will get if you ask people within the industry how much you should spend on marketing, especially if you're talking to somebody who works for a hearing aid manufacturer or works for a marketing agency, they will tell you that you should spend 10% of your revenue on advertising. But it's a very misleading percentage that really is not necessarily applicable to any individual practice, and we think may benefit those advising on the spend more so than the practice itself. And there are a couple of reasons why. Until you understand the practice's position and growth trajectory, it's hard to recommend a marketing percentage or say that one specific percentage works in that situation. A couple examples. One, a startup practice that is only acquiring new patients because it hasn't been in business long enough to generate repeat patients probably has to spend at least, if not more than 10% just to grow, just to get to a point of stability where it can begin generating referrals, whether it's word of mouth or from physicians, and ultimately reach the point several years in where patients who purchase hearing aids in the first year are coming back for their second pair. Second of all, certain practices have strong retail orientations and operate in competitive markets, which means they have to advertise pretty aggressively to prevent patients from going elsewhere or just to acquire new patients to grow. And again, 10% may very well be the right number there, but I've seen markets where it takes 15 or 20% spend on advertising to generate the required results. On the polar opposite end of the spectrum, you find mature practices that operate in affluent communities or operate in smaller communities that are positioned kind of within medical office buildings or oriented much more as part of the medical community than as part of the retail community. And those practices can do just fine spending 2 to 5% of their revenue on advertising. So understand that most people will tell you 10% is the right number for advertising, but it could be a very overly generalized percentage, and there's a lot more analysis that's required. Rent, on the other hand, is a little bit more black and white. Your rent cost should be a single-digit percentage. Generally, anything between 5 and 8% is considered good. In this case, this practice is at 6%, so rent is strong. You'll occasionally see rent below 5%, greater than 10%. It could be due to the size of the market and the cost structure of that market. Could simply be a startup practice that hasn't reached maturity yet. But by and large, if you see single digits for rent, then the practice has a responsible rent structure. We move all the way down to the bottom of this income statement. We see reported net income. So that is our reported profit for the year, gross profit minus all of these expenses down below. And then right below that, we see reported EBITDA. And if we were all in the room together, I'd ask you to raise your hand if you actually knew what EBITDA is, because it's kind of a foreign term to anybody who hasn't taken a finance class in the past. EBITDA stands for, I'm waiting for this to pop up. There we go. Earnings before interest, tax, depreciation, and amortization. So what does this mean? So EBITDA is another way to view the profit of a business and to put various practices on a level playing field. so that when you're analyzing the profit, you're making an apples to apples comparison. Because some of these expenses like interest, taxes, depreciation, and amortization are not going to be the same from one owner to the next, even within the exact same practice. So this is most commonly used when we're evaluating practices for financing or for purchase. But at the same time, it's a good benchmark to evaluate profitability under any circumstances. So we take the net income of the practice, and to that we add back the interest. So we took the $322,000 that we see as reported net income. We added $20,000 worth of interest. We added $50,000 worth of depreciation. There were no tax or amortization to add, and that's how we went from $322,000 of net income to $392,000 of EBITDA. And the reason we add these items back is as follows. Interest is an expense that you incur because you've taken out a loan. And if I own the business today and I'm paying off a loan from when I originally bought it or remodeled or for whatever reason, and I'm going to sell it to you, you are very likely going to be borrowing a different amount of money at a different interest rate than I currently have. So your interest expense will be different from mine. So what you want to see is what profit does this practice generate before it starts making any interest payments, because then I know what I have to work with and what I can leverage when I'm in financing discussions and understand, whether or not I can make my loan payment. Depreciation is a non-cash expense, as is amortization. So depreciation relates to any of the physical assets within a practice. You buy a piece of equipment, or the practice buys a car. You cannot write off the full expense of that piece of equipment in the year that you buy it. Instead, you write it off over a period of time, usually over 5 years. So if I spend $250,000 on pieces of equipment or the build out of my office, I'm depreciating that over 5 years, so I get to write off $50,000 a year. Now, I spend the money in year 0 or year 1, and then in the following years, I'm incurring the expenses. So in this particular year, this depreciation wasn't actually cash that went out the door. So if I want to understand how much cash flow the business is actually generating, I add back in the depreciation. And the same logic applies for taxes and amortization. We could spend an hour talking about EBITDA. There's a whole nother level to the calculation that involves adjusted EBITDA to reflect different styles of ownership, different synergies that companies bring. That's a conversation for another time. Right now, I just want to introduce everybody to the concept of EBITDA and then highlight that, kind of the target for strong performance for a small practice is 15% EBITDA. If you're at 15% or greater, you're doing well. 20% is very achievable. It takes some strong financial acumen and enough size to make that realistic. But 20% EBITDA is possible, and some of the strongest practices out there are generated north of 25% EBITDA. One other item I'd like to talk about when we talk about the income statement are fixed costs and variable costs and what we can do with them. So fixed costs are costs that the business incurs that are independent of output. They stay the same no matter what happens throughout the course of the year with the business. So for example, rent and salaries. You agree to a lease, you're paying the same amount of rent throughout the entire year. It may go up the next year, but for the first 12 months, that payment is fixed no matter what happens with the business. Salaries are the same thing. You hire somebody, you agree to pay them a salary, and until you give them a raise, you're paying them the exact same thing every week or every month or however frequently you run your payroll. Marketing is an expense that can certainly vary from one year to the next, but marketing is not driven by the revenue that you bring in. You set a marketing budget, you spend it the way you choose to spend it. You may adjust it throughout the course of the year, choose to spend more next year, but it's not, the amount of revenue you bring in does not automatically trigger a change in your marketing expenses. On the other hand, your cost of goods sold very much are driven by how much revenue you bring in, how much you sell. If you sell more hearing aids in a year, your cost of goods sold will increase, at least in terms of actual dollars, because you've had to purchase more hearing aids in order to sell more hearing aids. Similarly, if your audiologists are on any sort of commission or bonus structure, the more revenue they generate triggers additional commissions and bonuses that are payable to them. And so, when it comes to budgeting, and we're going to talk about break-even analysis in a second, when it comes to budgeting and calculating break-even, understanding your fixed costs and your variable costs and modeling them appropriately, is critical to a successful analysis. So break-even point, I'm sure everybody's heard this term before, but it's the point at which you generate enough revenue to cover all costs. You're not generating a profit, you're not generating a loss, you are completely neutral as far as that goes. And so, this type of analysis is especially critical when you're making a new investment. Let's say you decide to open a new office. It's going to cost you a decent amount of money to do a build out, meaning, any construction that's needed to fit the office to, become an audiology practice and make everything appropriate or make any necessary upgrades. There's an investment in the equipment, that's required to operate the practice. You need to understand, how much revenue do you need to generate to recoup those costs, and then going forward, you're going to incur, ongoing operating expenses. And how much revenue does that practice have to generate, just to break even first, and then ultimately become profitable. You might even look at a break-even analysis on a hiring decision. So if I'm debating whether I hire a second audiologist, I have to understand, what is that salary? What other costs are involved with hiring that audiologist? How much does she need to generate in revenue in order to cover all of those expenses? It doesn't necessarily have to be another audiologist. It could be expanding the front desk, it could be hiring a biller or a bookkeeper or any other position. Whether they're generating the revenue or you are, how much incremental needs to come in order to justify that decision. So down below, I'll give you two examples of how you would calculate a break-even point. The first is a little more simple than the second. So the first one here, ABC Audiology has fixed expenses of $60,000. The owner estimates that variable expenses will total $65,000. What's the break-even point? So this is simple math. Fixed expenses of $60,000 plus variable expenses of $65,000 equals $125,000. So you have to generate $125,000 in revenue to cover the $125,000 in expenses. There's your break-even point. Same practice down below. We're using the example now. They have fixed expenses of $40,000. And the owner forecasts that all variable expenses except cost of goods sold will equal $35,000. So before a single hearing aid is purchased or sold, the practice has total expenses of $75,000. So the question then becomes, how many hearing aids does this practice need to sell in order to cover this $75,000 of expenses? If we were in class at Rush, I'd pause now for 5-10 minutes, make everybody figure it out. But again, given the format doesn't allow it, I'll just tell you the answer. So, the other information we have here is that the majority of the revenue is derived from hearing aid sales, and for the purposes of simplicity, we're just going to assume that 100% of the revenue comes from hearing aids and 100% of the cost of goods sold come from hearing aids. Average sale price for hearing aid for this practice is $1,850. Average cost of goods for this practice is $650. If we subtract the cost of goods sold from the revenue, we have a gross profit of $1,200. So it's that $1,200 figure times the number of hearing aids that we sell that get us to the break-even point. The answer here is actually not a whole number. It's 62.5. So you sell 63 hearing aids, you generate a small profit, but $1,200 times 62.5 gets you to your $75,000, and that's how you calculate your break-even point in this example. Moving right along, and if you have questions, again, just please enter them in the question queue on an ongoing basis, and at the very end, we'll get to as many as we can. I'm going to move now to practice analysis and specifically talk about KPIs. KPI stands for Key Performance Indicators. This is also known as a benchmark. And these are ways to analyze clinical activity and determine, the strength of a practice, performance of a practice based on the clinical activity. For the most part, in audiology, when we talk about KPIs, we talk about hearing aid related benchmarks. And while these are not the only benchmarks that are important, these are what are most commonly utilized. And there are a couple reasons for that. The biggest is that, we live in a bundled pricing world. The vast majority of practices are still on bundled pricing models. So hearing aid sales, even though service and perhaps even testing is incorporated in that price, there's no way to, segregate other activity from the cost of the hearing aid. So hearing aids are generating 90% or more of the revenue in most practices. So those are the levers that, you can pull on to tweak performance. So in the light blue boxes here, we have 6 commonly used KPIs for hearing aid sales. Hearing aids sold per month, and if it's a multiple provider practice, we want to look at that on a per provider basis. This tells us, from a unit volume perspective, how productive each audiologist is, allows you to compare them against each other as well as against national averages. Hearing aid manufacturers love this metric because all of their sales reps are judged based on hearing aids per month. For a practice, I personally don't think it's as valuable as some of the other metrics, but it's still not completely invaluable, just given kind of the overall relationship between manufacturers and practices at all levels of the industry. Right below that, we see annual revenue per provider. Nationally, the average annual revenue per audiologist is in the $300,000 to $350,000 range. Interestingly enough, the benchmark for revenue generation is $500,000, but more specifically, it's $100,000 per day of the week that an audiologist works. So if they're working 3 days a week, that would be $300,000. If they're working full time, that would be $500,000. The reason that revenue is a bit lower is that we're incorporating all types of practice in here and not necessarily segmenting out part-time versus full-time, at least some of the surveys that I've seen. A function of these two metrics is the average selling price. So the number of the amount of revenue generated divided by the number of hearing aids sold tells you, the average price of hearing aids sold, and then that helps you understand technology levels. And so you can evaluate your staff and understand who's selling more premium technology, whose patients are more in entry level or mid-level technology. May or may not be a strong indicator depending on the markets in which different audiologists are working in. The next 3, return rate, close rate, binaural rate, are all pretty linked. So return rate is just the percentage of hearing aids that are fit that are then returned and not replaced by an alternative hearing aid. Close rate really measures the percentage of patients who purchase a hearing aid. I prefer to call this treatment acceptance rate. How many patients accept amplification as a treatment. The industry generally as a whole calls it a close rate instead. The best way to measure close rate is to adjust opportunities to only account for patients who actually have a treatable hearing loss. So if you have patients whose loss is so mild you can't really recommend amplification with a straight face, or so profound that they're a cochlear candidate, then you may not want to incorporate them into this analysis, and really just think about who are the realistic candidates for amplification, and then what percentage of those purchased a hearing aid. Lastly, we take a look at the binaural rate, and which on average nationally is about 80%. And so as you evaluate your staff, if you find that one audiologist revenue is lower than everybody else, and you notice that their binaural rate is 50% versus 80%, perhaps the issue is not the average selling price. Perhaps the issue is not the patient volume that he's seeing. It might simply be that the binaural rate needs some work, and if you can work with that employee on improving their counseling to gain greater acceptance of 2 hearing aids instead of 1, then you can improve a lot of these metrics all at the same time. These next 2 in the dark blue boxes speak to marketing performance. We have conversion rate and patient acquisition cost. Anytime you're running advertising, it's important to measure the outcome in a couple of different ways. First of all, your conversion rate really speaks to the funnel of interactions. And we can use direct mail as an example. Let's say you open your practice and you send postcards to 5,000 households in a 2-mile radius around your office. So you have 5,000 people who received the phone call. The first thing that you want to measure is how many of those recipients responded. Whether it's the phone call, an email, a social contact, how many responded? So that's the first conversion from the recipients of the mail to those who contact you. Of those who contact you, how many schedule appointment? That's the next conversion right there. Of those that schedule the appointment, how many show up for their appointment? Next conversion right there. After that is how many who show up have a hearing loss, and of those that have a hearing loss, how many purchase a hearing aid? That's your final conversion rate is the purchase of the hearing aid. And so this really helps you to measure the effectiveness of advertising, and you can measure it across a variety of marketing channels. Patient acquisition cost takes the total spend on a marketing campaign and divides it across the number of patients that are successfully treated or that generate revenue for the practice. So to use a simple example, let's say that postcard campaign costs you $3,000 and you have 10 patients who come in and purchase hearing aids. Which, by the way, 10 patients out of 5,000 is pretty darn good and should generate a return on investment that is pretty substantial for that $3,000 spent. But at the same time, that means it costs you $300 for each of those patients that came in and purchased. And so, just like it's important to evaluate conversion rate across various marketing channels, it's also important to evaluate patient acquisition costs. So you can better understand which of your types of marketing bring in more patients at a lower cost. If you find that your Facebook advertising can generate 5 patients a month at $50 per patient, and your direct mail is generating $10 a month, 10 patients a month, but at $300 per patient, there may be an opportunity to shift some of your marketing budget away from direct mail to Facebook, generate more patients for less, and become more profitable. This last circle, payer mix, speaks to who is actually paying for the hearing aids. And so you want to analyze a practice and understand how many patients, or really we look more at revenue, what percent of revenue is private pay. Private pay is self-pay patients, no insurance or any third party involved. How many patients have a hearing aid, have an insurance company paying for their hearing aids? How many are from Medicaid or some sort of government funded program? And how many are referred in by a third party like Hear.com, True Hearing, Hearing Care Solutions, things like that. By and large, it is indisputable the private pay patient is the most valuable patient to an audiology practice. And there are 2 reasons for this. One, it's generally in all but very few circumstances the most profitable patient that you will find, as well as the most loyal patient, because they tend not to be price sensitive. 2, it is the patient that is the most insulated from disruption, as opposed to insurance companies that can change their reimbursement rates at any point in time, or government programs that can completely change the way they function. And I'll give a very specific example of why this is important to understand, because if you're managing a practice, or especially if you're thinking about buying a practice, it's a great barometer of the risk involved in the ongoing operations. So in 2005, the state of Indiana decided to make a change to their vocational rehabilitation reimbursement for hearing aids. Most states have a vocational rehabilitation program. If patients are in the workforce, hearing aids are required to keep working, they meet certain other conditions, the state will pay for them to get a hearing aid. Prior to 2005, Indiana had a competitive bid system for hearing aid sales, meaning a patient meets the qualifications of the voc rehab program. They're referred to a practice. The practice diagnoses the hearing loss, recommends a hearing aid, and sends a quote to the state for the specific make, model, and price of that hearing aid. The state then solicits a competitive bid from another practice, doesn't send them what the price is, doesn't send any other information on the practice, just says, here's the product, what would your quote be? Whichever practice had the lowest bid would win. Now, this could mean that one practice quoted $7,500 for a premium pair of hearing aids. The other practice quoted $7,200 for that same premium pair of hearing aids. The lower bid wins, and the state of Indiana is paying $7,200 for that pair of hearing aids. That's a great system if you're a patient, and a state-funded system will give you a premium pair of hearing aids. It's a great system if you're the practice because you're getting the same, and in some cases getting more than you might get from your private pay patients who are you're otherwise serving. And the state eventually realized they had an opportunity to centralize the billing, purchase the hearing aids directly from the hearing aid manufacturers themselves, and then turn around and pay the audiologist a fitting fee to dispense the hearing aids for them. So this was kind of one of the first versions of all the third-party networks that are out there. And they went to a kind of dual fee model where they would reimburse the practice $500 for a monaural fitting and $750 for a binaural fitting. So overnight, you could go from making $7,500 off that pair of hearing aids to making $750 off that pair of hearing aids. Not exactly an apples to apples comparison because you don't have all the same expenses. So let's say we net out cost of goods sold and we net out advertising costs. Your gross profit net of also the advertising on that pair of hearing aids, might be $4,000, $3,500. Might even be $4,500. So you still went from netting $3,500 to $4,500 down to netting $750 off that pair of hearing aids. So it's a pretty scary situation. And if Voc Rehab was a couple patients a month for a large practice or a couple patients a year for a small practice, it's not fun, but it's really a nuisance. If Voc Rehab is 30% of your business at this point in time, it pulls the rug completely out from under you. So understanding the payer mix and the dynamics of the payers in a market is very essential. In general, if you're opening a practice, managing a practice, but even more specifically, it weighs pretty heavily in valuation if you're buying a practice. When we think about buying, I want to shift now to talking about how outside investors look at practices and what really drives value for them. And we've isolated 6 items here that really drive value for investors. These speak more to larger group practices and non-industry players who are buying practices, so private equity firms and other types of financial investors. Hearing aid manufacturers have a very different worldview of what's valuable to them, because when hearing aid manufacturers buy practices, they're really just doing it to lock up distribution. To them, they just care about selling hearing aids at the wholesale level, and anything they can do to guarantee future sales at the wholesale level is important. So they look at revenue, they look at the number of hearing aids sold, they look a little bit at profit, but it's a less, no offense to that, but it's a less sophisticated analysis. Whereas an investor cares about 2 things. What is the profitability of this practice and how sustainable is this income stream? And so, we can go just briefly through these 6 aspects. The first 2 relate to growth, organic growth and inorganic growth. Organic growth can also be known as same-store sales, which is a retail term. And it's a measurement of how established offices grow from one year to the next. Organic growth does not have to be a huge number. Generally speaking, 2 to 3%, just slightly faster than GDP for a mature practice is good enough. But it shows that if the group doesn't open any new offices, doesn't make any acquisitions, it can still keep growing. Strongly related to this is doctor retention. So, provider retention, if you also have dispensers in the practice, doctor retention, if it's all AUDs, call it what you want to call it. Retaining your key staff is critical to the sustainability and long-term performance of the practice. It's also directly related to organic growth. If you have several offices that are turning over doctors on a regular basis, those offices are likely not going to be growing, or certainly not going to be growing consistently. So in its own right, having strong doctor recruiting and retention strategies is critical to driving investor interest and receiving a strong valuation when selling, but also relates directly to organic growth. Inorganic growth, on the other hand, relates to new offices. Whether you are acquiring practices or embarking on a de novo strategy, which means starting practices from scratch, demonstrating the ability to grow inorganically and consistently add new offices to the group, also brings a ton of value to the investor. And, related to that is the cultivation of a strong pipeline of future opportunities. Again, whether those are acquisitions or new startups that are in the work, showing an investor that not only have you successfully done this in the past, but there's a pipeline for more in the future, drives a lot of value as well. Investors like growing businesses. They don't like flat or declining businesses, and showing growth in both ways, it really gets them excited and is kind of what drives the premium valuations for some of the best group practices out there. At the bottom, we have two final items that are related more to organization and ongoing operations. So one, do you have a management and support infrastructure? And really this is looking at, is each practice just its own four walls, its own clinic, and everything is happening, in-house within that office? Or do you have a team that has been built to manage the overall operation and support the activities of all of the individual offices? Have you built any sort of shared services infrastructure so that there's, a common HR team, a common marketing team, a common IT team that supports all of the offices? And then related to that, have you developed unified cross-platform systems, meaning are the same systems and procedures utilized across all the offices? This speaks to systems like practice management systems, IT systems, and accounting systems. So can you look at the financial statements of all of the offices and make an apples to apples comparison when you're looking at the individual office level and then have those consolidated at the top? Or do you have different accounting systems for different offices? Similarly, whether you're on Cycle or Blueprint or some other practice management system, are all of your offices using the same one and using it the exact same way, so that you can do a better analysis of the practices, both as the outside investor as well as the manager going forward? Then, outside of the kind of the technical components, are things like HR decisions handled universally across the platform? Are there policies and procedures so that your front desk staff at every office is handling things certain ways, whether it's how they answer the phone or how they collect money or the welcome, warm feeling that a patient receives when they walk into your office? Any of these, really speak to the strength of the practice and help to drive value across a platform. We'll move here now into strategic frameworks, and we're going to talk about two that are commonly taught in business school, a SWOT analysis and a QSP analysis. So first of all, SWOT analysis speaks to the strengths, weaknesses, opportunities, and threats of a practice. So strengths and weaknesses of the practice, these are internal in origins. These speak to the practice today, where it excels, where it has room for improvement. Opportunities and threats are what is facing the practice. This is external in origin. So this is kind of looking at the future, looking at the outside and thinking about opportunities for growth and threats to sustainability and survival. Here I have taken a SWOT analysis that we did for a client recently and just repurposed it a little bit to change the geographic market and change certain things to make it anonymous. So this practice, I highlighted 6 items for each. So, strengths, I'll just pick out a couple here. Consistent year-over-year revenue and earnings growth, strong brand recognition, strong doctor retention and recruiting, and rapid recovery from the shutdown that we just experienced with the pandemic. So a lot of things that are probably similar to what we just looked at as value drivers for investors, but really speak to a strong practice. Now this practice has attempted to build out a management team and a support infrastructure to support its offices, but there are some gaps on that team. There's been a bit of turnover. It's also a practice that has been a little bit inconsistent from one office to the next. Production per audiologist varies pretty dramatically across the offices, as do certain expense items. And some of these weaknesses speak directly to the opportunities that the practice faces. So reorganizing the support team will reduce overhead costs and make the practice more profitable. Drive consistent levels of cost of goods sold and average sale price at each practice will bring profitability and some of those financial ratios in line, across the practice. There's a lot of growth opportunity, for this practice. In the immediate future, we think there will be some acquisition opportunities coming out of COVID as practices decide that, or owners decide that they don't want to do this anymore, that they're burnt out, they'd rather sell and work for somebody else than continue to fight the fight on their own. This example, we're locating the practice in the Bay Area, and in the practice's real market, it dominates, one county of a strong multi-county, geographic area. And so, expanding out of its current county to blanket the broader metropolitan area would really give it a dominant foothold, in the market. And then looking at threats, we have some more kind of immediate real world threats, as well as some that are a bit more, esoteric and long-term, but it can't be ignored. Every audiology practice is facing pricing pressure from third parties. Hiring is a challenge everywhere, and finding really good people, especially for the non-clinical staff, the front desk, the billers, different, clerical staff positions, is really, really challenging. Who knows what the future holds with the pandemic and whether or not we'll have another shutdown. And then, we've always talked about this, and I've been, involved in discussions about these last two topics for the, entire 17, I think it's been 17 years that I've been in the industry now. The development of substitute products, the development and adoption of alternative delivery channels that, may make, the traditional brick and mortar practice less attractive to patients. I don't ever want to use the word obsolete, but certainly less attractive to patients. We're getting close to the end of the time here, so I'm just gonna keep moving, and we can come back to any of this stuff when we get to the Q&A. The other analysis I want to share is called QSP, which stands for quality, service, and price. And the theory is that no brand or product can achieve a leadership position in all three categories. You can't have the best quality and the best service and the lowest price and remain in business for the long term. One of the three must suffer in order to be great at the other two. And I pulled out a few well-known brands here, both within and outside of the industry. So if we think about Costco as an example, Costco generally has great products. This speaks to everything they sell, whether it's food or electronics, or hearing aids. If you go buy a hearing aid at Costco, you're getting a Phonak, Resound, or Signia product, the exact same product, just with a different brand name, but the exact same product that you would purchase from an audiologist in a traditional practice, and you're buying it at a rock bottom price. So they excel at the quality of the product, they excel at the price, but the service lacks, the experience lacks. You are buying your hearing aid on a concrete floor in a warehouse from a dispenser who may not have that much prior industry experience. And no knock on dispensers, there are some great ones out there. Costco does have a really strong training program to try to bring their providers up to speed in a very quick fashion, but they have significant limitations in their experience, their capabilities, their scope of practice that you will just never find in a Costco and will only find in an audiology practice. Olive Garden. Olive Garden is and I realize I'm speaking to a bunch of college students here who probably dine differently than me, but we're not talking about the world's best Italian food here. So quality of the food is definitely lacking in exchange for great pricing, attentive servers who are always refilling your bottomless breadsticks, and generally providing quality service experience. Nordstrom's another group that's really known for service. Nordstrom is staffed with sales associates that are very knowledgeable about the products that they sell. Nordstrom also has a famous return policy where they will take any return, no questions asked. Very premium products, quality is very, very high. What suffers with Nordstrom is the price. You're gonna pay for what you get, and it's not gonna be the same as when you buy things online or buy things from Macy's or even less expensive retailers. Amazon is a retailer that I get a lot of pushback from when I talk about this in class, because Amazon is the one retailer that people like to say excels at all three. And I'll tell you why I don't think they excel at all three. I think there's a quality and service component that's lacking. There's no question that the pricing on Amazon is phenomenal, and they have every product that you want. A lot of the products are very, very high quality products, and I can get a lot of them delivered to me in a day, if not the same day. So how could it not be great quality, great service, great price? Well, they have hundreds, if not thousands of SKUs of many of the products they carry. And unless you really know what you want to buy going in, you have to do the research on your own. There's nobody to help you out. Further, there's no quality control. So whether I'm buying an apple from Whole Foods or a piece of electronics, there's nobody who's QC that apple to know that it's not already going to be moldy when it shows up or expire tomorrow, as opposed to lasting for a week. Lastly, if you buy something directly from Amazon and you have a problem, the returns are pretty simple. But if you buy from a third-party reseller, which you're not always noticing if you're buying something in a hurry, returns, questions, other issues can be a bit more challenging. So price, no question, quality and service at various points, but definitely not excelling across all three. Let's wrap this up and just briefly talk about the current environment and how that relates to analysis, and then we'll take as many questions as we have time for. So if you were to be evaluating a practice today, whether for purchase or for an academic exercise, you'd really want to assess the COVID period and what happened. First question you want to ask is, did the practice close? And did they close completely, or did they remain open for emergencies? And if they remained open, what did that look like? What did they do? The financial performance last quarter is less of an interesting data point because everybody suffered financially. So you want to understand the financials, but you really want to understand operationally and anecdotally, what did they do? Financially, you want to understand, when did they reopen and how have they performed since reopening? Nationally, across all of healthcare, not just audiology, but audiology included, June and July have been tremendously strong months for the practices that have been opened. Patients have been coming back in, schedule books are full, revenue is back up. Many practices are reporting the best months they've ever had. It is to be determined as to whether or not this was pent up demand and we're going to dip back down, or it's sustainable for the long term. But it is an objective fact that most practices have reopened very strongly. Lastly, you want to kind of use this analysis to do a more fundamental assessment of the practice's ability to handle disruption. We saw practices that implemented curbside service and other unique service offerings while they were only open for emergencies, and they were able to help patients of competitive practices that were completely closed and not able to do anything. They will gain new patients as a result of doing that. They will grow and be stronger as a result of doing that, and it will be to the detriment of their competition. And disruption is something that's faced audiologists in one way, shape, or form for the last couple of decades. We've had the internet, we've had Costco, we've had these third-party networks. When Costco came into your town, did you grow or did you decline? Were you the audiologist who was scared and tried to compete with them on price and ultimately lost? Or were you the audiologist who walked over to the local Costco, introduced yourself to the dispenser, explained your credentials, and offered your help? If they had a case they couldn't handle on their own, if they had a kid, since they don't handle pediatrics, you'd be happy to take care of that patient for them. You'd be happy to answer their questions. Guess what? Practices that did that grew and didn't shrink, even if Costco was on the same block as them. So, whether we're looking at COVID or Costco or other aspects of disruption, the adaptability and creativity of an ownership team or a management team and a practice as a whole, is critical. And evaluating a post-COVID practice gives you a really good window into, this aspect of the practice itself. I feel like I've been talking fast, but we are done here. So thank you all for joining this evening or whenever you decide to watch this. And we'll hand it back to Brian and see if we have any questions.
Thank you, Craig, for that informative presentation. We do have some questions in the queue. The first question is, what do you think the ratio of devices sold to the diagnostic services is safe?
Well, I would look at that from a dollars and cents perspective. It really looking at revenue, because The procedure, I'm not sure that I know a way to evaluate the procedures that would be more generally acceptable. And safe, is really relative. So I would say most practices are generating 90% plus of revenue from hearing aids, and the bulk of the rest is coming from diagnostics. Those that are a bit more diagnostic oriented are closer to 20% from diagnostics, 80% from hearing aids. There are practices out there that focus on tinnitus, focus on other diagnostics offerings. They're not as profitable necessarily as those that are driven by hearing aid sales, but they're strong practices nonetheless. They help the owners achieve whatever objectives they want to achieve from both an income perspective and kind of a mission perspective. And so it's not to say that that's bad, but at a point at which hearing aid revenue is less than 80% of total revenue, we would look at that as an area of concern and really have to question why the numbers shook out that way.
Alrighty. So this question has two parts. First part is when would a small private practice start looking for investors?
So you're going to look for investors generally for one of a couple of reasons. One, you just want to sell, and the investors that you're selling to are an alternative to another audiologist who would buy. Two, you want to grow faster than you're capable of growing. And the limitations to your growth could be based on how you're currently financing the practice. So a much lengthier discussion for another time is the fact that almost all practice financing in the industry comes from hearing aid manufacturers. Manufacturers give loans to audiologists. That's how they buy practices. It is way more practical to get a loan that way than to go to a bank, because the way banks lend to audiologists is very inefficient and expensive. But there are going to be limitations to the financing that you can receive from hearing aid manufacturers or from banks, and they may hinder your profitability or your growth rate. So, if you're big enough to attract an investor, which usually requires at least $1 million of profit a year, that may be another component to the answer here is that figure. You may look at an investor as a great way to accelerate your growth, without having to bring on more debt. I think lastly, one area that we see is interesting is most investors, we think of an investor as somebody who's financially oriented and coming in from outside of the industry. They don't want to operate the practice. They want to invest in something that will grow faster than an investment in the stock market will grow and have a totally different return profile. So, if you're in the latter stages of your career, and you've owned the practice for a while, you may make a great living, but you may also have a significant portion of your net worth in the practice itself. And so receiving, some cash from an investor in exchange for equity in your practice can be a great way to diversify your personal risk. So it's a strong financial planning strategy, allows you to still own the practice, allows you to participate in the future upside, but it de-risks you personally from any potential downside associated with ownership.
Great, and I think you did touch on the next part of the question is who invests in audiology practices?
So there are a few private equity investors. So private equity firms raise money from outside investors themselves. So it's a fund. Everybody knows what a mutual fund is, and anybody can go invest in a mutual fund. They're publicly traded. Private equity funds are privately raised funds of money that invest only in private companies. And they have pension funds and insurance companies and high net worth individuals, and they're managing hundreds of millions, if not billions of dollars, and they're buying privately held companies, owning them for 5 to 7 years, and then selling them at a gain. So you have some private equity interest and activity in audiology. You're also starting to see private equity invest in ENT practices. You will have some high net worth individuals as well, that are a bit less visible and harder to find because they may not necessarily market themselves as investors. But, locally you'll find retired or semi-retired entrepreneurs, people who have sold companies and, generated a healthy nest egg that they want to then invest forward in other small businesses. They will invest as well.
Great. The next question is, if you operate an unbundled practice, how do you set service and diagnostic pricing?
So you want to understand the trade-off between bundled and unbundled. And if you're trying to make the switch from bundled to unbundled, you want to evaluate the 3-year revenue, and ensure that if the patient comes in for services over the 3 years or is purchasing the service plan across 3 years, that you're able to make the same amount of money off the services as you do selling the bundled hearing aid. Diagnostics is a bit different because if you're billing Medicare or private insurance, you may be a little bit limited in terms of what you can bill anybody else. You certainly can't bill somebody else less than you bill Medicare. You could potentially bill them more, but you're held in check, especially on things like hearing aids, because so many patients will have Medicare. Hearing aid dispensers will offer free hearing tests since they can't charge for them. So you have some limitations there. But ultimately, if you're starting a practice from scratch, it's about modeling break-even point and what it's going to take to get to profitability. If you're converting a practice from bundled to unbundled, the analysis really revolves around how do we ensure the same levels of revenue and profitability if we're not collecting all the money up front.
All right, and then we have time for one last question. The next question is, please define what an amortization expense is.
I hoped I could skip over that for the sake of brevity. So amortization is another non-cash expense, and it relates to an intangible asset. So it's really the same thing as depreciation, only it applies to a different type of asset and covers a different period of time. So depreciation, if you remember, relates to physical assets. You buy some equipment, you buy a building, you buy a vehicle, and you can, in the case of vehicles and equipment, you can expense that over a 5-year period of time. Amortization is the same concept applied to goodwill, intellectual property, any other intangible assets. So let's say you buy an audiology practice. There are not that many fixed assets in an audiology practice. You have some furniture, you have some computers, you have some diagnostic equipment. If you spend $500,000 to buy that practice, $50,000 to $100,000 may be in all of those physical assets. The rest that you're buying is the goodwill, right? It's that brand name and brand recognition. It's that loyal patient following. It's that ability to generate cash flow in future years. That portion you expense over 15 years, and it's known as amortization. And so in the EBITDA calculation, we add back depreciation and amortization for the exact same reasons, because they're non-cash expenses on the P&L. And if you're buying the practice, you're going to have a completely new depreciation and amortization schedule of your own related to that purchase of the practice. So, the amounts being expensed by the previous owner will be irrelevant to your ownership.
Great, thank you. Thank you, everyone. We are out of time for today's session. If you have additional questions, please send them to info@audiologist.org, and we will forward them today to today's presenter. If you have friends and colleagues that were unable to attend the webinar today, please let them know that the session has been recorded. We will send a link out to attendees after the recording is posted. For more information about future SATA practice management webinars and to register, please visit www.audiologist.org/students. Thank you and have a great evening.